Okay, let's look at the tape. If you were watching the after-hours action on Capital One last night, you saw some serious turbulence.
Yeah, that's one way to put it.
We closed the regular session comfortably, around $235. Everything looked calm. And then, boom, the print hits, and we see an immediate air pocket. The stock drops over 5% in a matter of seconds, trading down into the high $220 before it finally clawed back to settle around a 3.3% loss. It was violent, and it was immediate.
It was a messy close to the day. And honestly, if you just glance at the headlines, you can see exactly why the algorithms hit the sell button.
Absolutely.
You have a bottom line earnings miss, you have this massive spike in credit provisions, and then, just to make things really complicated, they announce a $5.15 billion acquisition of Brex.
Too much to unpack there.
It was a very noisy quarter. This wasn't a clean beat and raise. This was a we have a lot of explaining to do quarter.
Noisy is putting it lightly. We need to unpack this because there are three distinct stories colliding here.
Yeah.
You have the Q4 numbers, which were, let's be honest, a bit of a mixed bag.
For sure.
You have this credit brownout narrative, which we'll get into.
Yeah.
And then you have this massive strategic bet on Brex. So what is the mission for this deep dive?
I think the mission is to figure out if that 3 to 5% drop is a buying opportunity or a huge warning sign.
Right.
We need to understand if the credit normalization they're talking about is actually stabilizing or if that provision build is hiding something worse. And we need to get into why Rich Fairbank, who's usually the most disciplined CEO in the room—
He's the guy who avoids shiny objects.
Exactly. Why he decided now is the time to drop $5 billion on a fintech darling.
Exactly. So let's start with the results snapshot, the headline number that everyone saw. Adjusted EPS came in at $3.86. The street was looking for somewhere around $4.14.
Yeah, that is a 0.28 miss.
In the banking world, where models are usually dialed in so tight, that is not a rounding error. That's a whiff.
It's a significant miss. But here's where it gets nuanced, and this is where you have to look past the headline. If you look at the top line, revenue was actually $15.6 billion.
That beat expectations.
It beat them by about $130 million. Revenue was up 1% sequentially. So the core engine, the business of swiping cards and collecting interest, is actually generating cash.
So where did the miss come from?
The reason for the EPS miss was entirely down to the provision for credit losses.
Let's drill into that because that was the scary number on the print. $4.1 billion in provisions for the quarter.
Which is a $1.4 billion increase quarter over quarter. That is a massive jump.
Okay, for the listener who might just see that headline and panic, let's define what that provision actually represents. Is that money out the door? Is that cash they set on fire?
Not necessarily, and this is a crucial distinction. Think of provisions as a rainy day fund that the bank is legally required to fill up based on complex, forward-looking models.
So it's an expense?
It's an expense line item on the income statement, so it hurts earnings today. But it's not necessarily cash leaving the building yet. It's the bank saying, based on our models, we expect we might lose this much money in the future, so we're setting it aside now.
So it's a prediction, not a realized loss. It's a buffer.
Correct. It's an accounting maneuver. And whenever you see a provision build of that magnitude, that $1.4 billion jump, the immediate fear is the consumer collapsing?
Does Capital One know something about the economy that we don't?
Exactly. But when you listen to the call, the CFO, Andrew Young, broke it down. A big chunk of that $335 million, specifically in the domestic card segment, was an allowance build.
Which means they were just increasing the size of the safety net.
Exactly. And the reason for that build wasn't necessarily because they predict economic doom. It was largely driven by loan growth and just seasonal factors.
Right. When you issue more loans, you have to set aside more provisions immediately, even if those loans are good.
It's just the cost of doing business.
Right. But the market saw that provision line and got spooked. However, despite the earnings miss and this massive provision build, they are still returning capital.
Oh, yeah?
They bought back $2.5 billion in stock this quarter. And this was a bit surprising to me. They hiked the dividend by 33% to $0.80.
Which is a massive signal of confidence. You don't hike the dividend by a third if you think your balance sheet is about to implode from bad loans.
No way.
Dividends are sticky. CEOs hate to cut them because it crushes the stock price. So raising it this aggressively tells me management thinks the provision build is temporary noise, not structural rot.
They're saying we have the cash flow, relax.
Exactly. But clearly, the market looked at the provision build and the EPS miss and decided to sell the news first and ask questions later.
Okay, so that's the earnings noise. We have a revenue beat masked by a provision build. But the headline that really dominated the tape was this acquisition. Capital One is buying Brex.
The big one, $5.15 billion, 50-50 cash and stock.
This is a huge pivot. Why Brex? Why now?
This is fascinating because it signals a fundamental shift in Capital One's identity. Rich Fairbank spent a lot of time on the call explaining this. Historically, Capital One dominates in what they call personal liability.
That's your consumer credit card, or even a small business card where the owner personally guarantees the debt.
Exactly, like the Spark card. If you open a bakery and get a Spark card and the bakery goes under, Capital One comes after you personally. Your house, your car, your credit score.
The risk sits with the individual.
Precisely. But Brex plays in corporate liability. That's where the business entity itself is on the hook. This is the world of venture-backed startups, mid-market companies.
The big leagues.
Yeah, large enterprises. Fairbank called it a move to capture the business payments platform. They aren't just buying a credit card book, they are buying a spend management software suite.
And the client list is impressive.
Yeah.
We aren't talking about the local dry cleaner. Brex has OpenAI, DoorDash, Scale AI, and Anthropic
The heady hitters.
of the Silicon Valley ecosystem.
That's the why. Capital One wants access to that ecosystem, and organic growth in the B2B corporate liability space is incredibly slow. You can't just mail out flyers to OpenAI and hope they sign up.
You need the platform.
You need a platform that integrates with their operations. And Fairbank was practically gushing about Brex's tech stack.
He really was. He kept emphasizing that Brex was built bottom up.
Yeah.
But let's be real. Every fintech CEO says their tech is modern and cloud native. What's the actual value here?
Well, I think it's the difference between remodeling a Victorian house and building a smart home from scratch.
Okay.
Most legacy banks are stitching together third-party vendors to handle corporate payments. Brex built their own core, 100% in the cloud, with real-time ERP integrations.
ERP meaning enterprise resource planning. So hooking directly into NetSuite or Oracle.
Precisely. And that integration is the secret sauce. Brex has AI agents that handle expense management and audit in real time. So an employee at DoorDash swipes a card, the software automatically categorizes it, checks company policy.
And syncs it to the accounting software instantly.
Instantly. Fairbank is obsessed with technology, and he sees Brex as having solved the technical debt problem that plagues business payments. He's buying the plumbing as much as the customers.
It sounds great on paper, but, and there's always a, but this deal isn't free.
No, not at all.
And I don't just mean the $5.15 billion price tag. Management admitted this is going to be dilutive to earnings initially.
Yes, and that's part of why the stock is down. It's about a 40 basis point hit to their CET1 capital ratio.
Let's pause CET1, Common Equity Tier 1. In plain English, for the person who isn't a bank regulator.
That is the bank's safety cushion. It's the core capital they have to hold against their assets to stay solvent in a crisis. Regulators watch this number like a hawk.
So a 40 basis point hit isn't dangerous for Capital One?
No, they're well capitalized, but it reduces their flexibility. It means slightly less money available to buy back stock or weather a storm.
And investors hate dilution.
They hear strategic long-term value and they see short-term earnings drag.
Fairbank is arguing that this is defensive offense.
Right.
If they don't buy this platform now, they risk missing the boat. But for a trader looking at Q1 2026, it's just a cost.
It feels like the classic Capital One playbook, though, doesn't it? They are willing to take the hit on their efficiency ratio to build these massive platforms.
Define efficiency ratio for us quickly while we're on the financials.
It's basically how much it costs to generate $1 of revenue. A lower number is better. Capital One is saying, our efficiency ratio is going to look bad, meaning we are spending more because we are integrating Discover and absorbing Brex.
They've done this before.
They did it with Auto Navigator, they did it with Capital One Shopping, and now they are doing it with Brex. They are sacrificing the short-term look of the P&L to secure a growth engine for the next decade.
Let's pivot back to the core business because there was a term used on the call that really caught my ear. Management talked about a brownout in loan growth. That sounds ominous.
It does. It's a very specific reference to the legacy Discover portfolio. Remember, they are still in the thick of integrating Discover after that massive merger.
Right.
The brownout refers to the headwinds they are facing in growing that specific book of business.
Because Discover had already pulled back before the merger.
Yeah, correct. Before the acquisition, Discover had tightened its credit box significantly. But now, Capital One is adding their own layer of caution. Fairbank mentioned they are trimming the edges of Discover's underwriting, specifically targeting high-balance revolvers.
Which is interesting because high-balance revolvers are usually the cash cow for credit card issuers.
They're the most profitable.
A revolver is just someone who doesn't pay their full balance every month, so they pay interest. That's where the profit is. Why would they trim that?
It is where the profit is, but it's also where the catastrophic risk lives. A high-balance revolver is great until they lose their job, and then you have a $20,000 write-off instantly.
I see.
Capital One has always been a bit allergic to that specific profile, so between Discover's old cutbacks and Capital One's new trimming, you get this brownout. Growth in that portfolio is going to be negative or flat until they finish the tech integration.
So we shouldn't expect the Discover engine to really fire up until...
When? Mid-2026. That's the timeline they gave. Debit migration to the Discover network is nearly complete, which is a win.
But the big one...
But the big catalyst originating new Capital One credit cards directly on the Discover network doesn't start until the middle of this year.
And that's the key right there, bypassing the network fees. That's the vertical integration play.
Exactly. That's the holy grail. But until mid-2026, we are in the brownout phase.
Let's talk about credit performance because that provision bill we mentioned at the top didn't come out of nowhere. The actual metrics moved too. Domestic card net charge-offs, or NCOs, rose to 4.93%. That's up 30 basis points quarter over quarter. Delinquencies are up to 3.99%.
This is the friction point in the narrative. Management's script is that credit is settling out and stabilizing. But if you are a bear, you point to the provision bill and say,
if credit is stable, why are you setting aside an extra $1.4 billion?
Precisely. And the answer seems to be a mix of that loan growth and just prudent reserving. They aren't predicting a recession, but they aren't releasing reserves anymore either. They are building.
Filling the sandbags.
Exactly. And to be fair to them, look at the auto segment. Auto charge-offs were 1.82%, down 50 basis points year over year. That's actually a really strong story. The stress isn't systemic. It is really idiosyncratic to the card portfolio.
Speaking of the consumer, Rich Fairbank dropped a macro nugget that I think went under the radar for a lot of people, but it's crucial for modeling the first half of 2026.
Tax refunds.
Yes, he talked about tax refunds.
This was a very specific, very tactical call out. He mentioned that due to the retroactive tax cuts passed last summer, the 2026 tax refunds are going to be significantly higher than usual.
It's a liquidity injection. It's helicopter money.
It is. He expects a massive one-time tailwind for credit repayment in Q1 and Q2. Consumers are going to get bigger checks from the government than they are used to.
Which makes the credit metrics look beautiful for a few months.
But he also put a big warning label on it.
What was that?
He explicitly called it a one-time benefit because withholdings will adjust downward for the rest of the year. So people get a big check now, but their monthly paychecks might look different later. He warned analysts not to model this as a permanent improvement in the consumer's health.
It's a sugar high.
It's a sugar high.
A sugar high. That is a perfect segue. We've covered the earnings miss, the Brex bet, the credit brownout, and the macro setup. Now let's get into the fun part.
Is this disclaimer time?
This is disclaimer time. What we are about to discuss is absolutely not financial advice. We are reading the tea leaves from the earnings call and constructing a hypothetical trade.
We are just two voices on a podcast.
Do your own due diligence. Do not trade based on what you hear in a deep dive.
But if you were running a macro hedge fund pod, this is the trade you might be pitching to your risk committee this morning based on Fairbank's comments.
Okay, lay it out. The refund sugar high pair trade.
The thesis is simple. Fairbank just told us that the lower end and middle income consumer is about to get a massive unexpected check from the IRS in March and April.
And the market hasn't fully priced it in.
I don't think they've priced in the magnitude or the timing of this liquidity event.
So how do we play it?
Step one, you go long subprime consumer discretionary for March and April. Think about where that refund money goes. Yes, they pay down some debt, so a long on Capital One or Synchrony makes sense here too. But a big chunk of found money goes to deferred discretionary spending.
We're talking about the things they've been putting off. Replacing the old TV, buying a used car, getting new clothes for the kids.
Exactly. You buy calls on those sectors expiring in late April. You ride the sugar high. You rent the consumer for 90 days.
But here's the twist.
Here's the twist. You have to hedge it. Or better yet, flip it. because Fairbank said withholdings adjust downward. That means the liquidity dries up fast in Q3.
The crash after the sugar high.
Right. So the pair trade is to short consumer staples or weak discretionary names via June or July puts. Once that refund money is spent, the consumer hits a wall. Inflation is still sticky, as Fairbank noted, and when the refund cash is gone, the hangover starts.
So long the refund recipients in Q1, short the hangover in Q3. It's a timing trade based entirely on a bureaucratic quirk of the tax code that Capital One just highlighted.
It's wild, but it's plausible. The data is there. The retroactive tax cut is a real cash flow event that the algorithms might be underestimating.
I love it. Again, not financial advice, but a fascinating way to look at the macro picture through the lens of a bank CEO's commentary.
It's a reminder that these earnings calls aren't just about the company reporting. They are a window into the whole economy.
So bringing it all back home to Capital One, the stock is down. The market is grumpy about the earnings miss and the dilution from Brex. What's the final verdict on the quarter?
It's a transition quarter. It's messy. If you are a short-term trader, you hate the provision build, you hate the EPS miss, and you hate the dilution. The sell-off makes perfect sense.
What?
But if you take a step back, look at what they are building. By mid-2026, they will have Brex clients moving onto their balance sheet. They will be originating Capital One cards directly on the Discover network, bypassing Visa and MasterCard fees.
They were building a vertically integrated payments monster.
And they are paying for it now. They are taking the pain now. The efficiency ratio looks bad today, so the return on equity can look amazing in 2027.
It's a high-stakes bet.
It is. Fairbank is betting the farm on this tech stack and this network integration.
And as we know, Fairbank usually plays the long game better than almost anyone in the industry.
He does. But for now, expect the stock to be in the penalty box until they prove that provision build was just a blip and not a trend.
Keep your eyes on the tape. The next few quarters are going to be critical to see if this brownout lifts and if the Brex bet pays off. Thanks for diving in with us.
Always a pleasure.